This is Jonathan Baird with Mustard Seed Wealth Management. We've had multiple clients call in inquiring about how the uncertainty during an election cycle may affect their portfolio, and so we wanted to give some information from historical returns, looking at some data to maybe help allay some of those fears. Now, this presentation shouldn't be construed as individualized investment advice. Each portfolio is going to be different. Your goals are going to be different from each other. And therefore, if you do have questions, please give us a call, and we'll be glad to chat with you about these and any other questions you may have. So let's look at returns during and after election years. We have data going back all the way to the Hoover administration in 1928. But you can see that the average return the year subsequent to an election, after an election, is 9.3%. The average return during election year is about 11.2%. Both are positive, and therefore we conclude that it's a good time to be in the market during an election year and the year after as well, historically speaking. The annualized returns during each of the presidential terms, so 4-year periods, you can see those as well, going all the way back to the Hoover administration. Average return, of course, is about 10.1% since then of the S&P 500, but there are no clear patterns here that would give us any hints as to what we ought to do to time the market, depending on the political affiliation of the president either. There are no clear patterns there. We've looked at domestic markets. Now let's look at international markets. A similar pattern is here. There is a little bit more noise in this because we don't have as many data points. But the average return in the year subsequent to election in international markets, looking at the EAFE index, is 13.5%. The average return during an election year is 6.5%. Again, both positive, but again, no clear patterns emerge that would help us to time the market. And here again are the annualized returns during presidential terms, going back to the Nixon administration. The average overall 8.9%, but again, no clear patterns here that would give us a hint as to how we should time the market. Fixed income, similar story, even less noise I think here because fixed income is in general less volatile than stock markets. The average return the year after an election of 8%, average return during election year 7.8%. And you can see here from this slide kind of a trend, a downward trend of fixed income over time, and that makes sense given the fact that interest rates have been falling for so long. But again, no clear pattern here that would tell us we need to be in or out of the market during at this point during an election cycle. And so the bottom line, as far as we're concerned and as far as the advice that we will probably give to our clients, is that it's very difficult to identify any systematic return patterns during election years. So there's no clear pattern there. And on average, market returns have been positive both in election years and in subsequent years. So positive returns during, positive returns after in general. And then also that market expectations associated with election outcomes are embedded in security prices. So we believe that any concerns that are out there have already been priced into the market. And therefore to try to take advantage of those mispricings, that you really can't do it because they're already priced in to securities prices. As always, if you have any questions, please feel free to give us a call. You can call us at our main office, or if you're in El Dorado or Hope or anywhere else and you know your particular advisor's number, please give them a call, and they'll be glad to chat with you about this or any other questions that you may have.